Have you guys heard of the missing middle and wondering how do I go about building that? Well, in today's video, we're going to teach you exactly what you need to know about starting your first development. Stay tuned.
Hey guys, Aaron and Josh here, back with another video, and today we want to talk to the first-time developers and guys that are getting into construction for the first time. Maybe even your second or third project, you might want to sit and listen to this, but we want to touch on some areas that we think are really important for you to focus on when getting into construction, especially for your first time.
Yeah, I mean, construction financing in and of itself is pretty complicated. You got different lenders giving different amounts of leverage, different costs associated with it. Some of them have different requirements. So we wanted to do is create a video that was going to give you kind of a high-level understanding of what you're going to need, what you should have prepared, and what kind of options you have available to really kickstart your first project. Now, what we're seeing in the market right now is kind of the same thing we've been echoing for the last 2 years. A lot of retail capital is getting into this missing middle multifamily development space, trying to find a way to be able to create more cash flow in these assets to allow them to be able to continue kind of the flywheel moving. The same kind of concept as we had with duplexes, but that no longer works due to the cost. So, how do you get into this project? And we talk a lot about the takeout financing and CMHC financing when it's done, but how do you actually get it from ground up and actually structured? So let's dive into it. First things first, the actual debt itself. Construction financing, when you're looking to submit the file, is a handful of things we're going to need. The first thing we really need is just to understand value as a whole. Acquiring the land or having a pre-existing land, you're going to need an appraisal. The appraisal is going to give us a determination of how much equity you have if you already have it, or what the property is going to be worth when you're buying it, and what is it going to be worth when the project is complete. So, a really important thing is we have an understanding of what it's worth now and what it's going to be worth when the project is done.
Yeah, to be able to get to that point of getting the appraisal, there's going to be a few things we're going to need. One, ideally, maybe a budget. It's not going to be as important, but at least it's going to give us an idea of the numbers that we're looking at. You're definitely going to have some sort of rental pro forma that the appraiser is going to be able to work off of. And ideally, you should be able to have your floor plans available. So he's going to be able to take a look at the rent per square foot. Does it make sense? Could we maybe get a little bit more, or are you being way too aggressive with your market rents that you're projecting? It's also going to help him base his estimate on your expenses as well too, using some sort of like per unit cost based on similar comparables in the area. But once you have those documents, getting the appraisal, like Josh said, that's going to be able to get our ground started in terms of just making sure we're in the ballpark of where the as completed asset's going to be. And then based on the rental income and the expenses, can you actually qualify for the size of construction loan that you're working for? As we said before, your construction loan only works if the takeout works. So if you're trying to get 95% or 80% cost, whatever that number is, you can only get that if the takeout financing works, and we need those initial pro forma docs up front.
Yeah, the challenge with development, and probably the reason why most people don't do it, is it's kind of complicated. You have to do things in a certain order to be able to get to having a full package to even submit the file. Like you can't submit for an as-complete valuation without, as you said, have drawings, having floor plans, having sizes of units. So it's kind of tricky without actually owning the land. At the end of the day, like owning the property, you're going to need to have a decent understanding of what you can put on it, and then spending money on soft costs to be able to actually get it to that point. So a lot of people, they'll actually come to us after they own the land, or
the question is, how do I guarantee that me buying this land is going to turn into a project that works? And the answer is you don't. You kind of have to either take the risk, or if you've done similar projects and you're buying a similar size land, then you can just base it on it. But unfortunately, until we have the pro forma and the numbers, we don't know ahead of time.
Yeah, it's really challenging. Very, very much a cart for the horse situation. So once you have all those things in order, putting a package together to allow us to dive into it, we need all the pieces of the puzzle to be able to present it to the lender. When you're looking to present something like this to the lender, on top of all the, I'd say specific things like the reports and all the hard things, we really need to also understand your experience. One of the most important things that a lender is going to require when they're looking to give you capital is to understand, well, have you built anything before? Like, did you just hang up something in your house, or did you help your dad build a shed, or have you actually built something ground up before? If you are looking to build a project ground up and you haven't done so, it's going to be very difficult to do your first project with a bank. A lot of the banks come to us and say, we'll do your second project, we're not going to do your first. So, if you don't have any experience in directly doing it by yourself and you want to go with a bank, you're most likely going to require some sort of GC or somebody who has experience with similar size and scopes of projects to be able to get it off the ground for you. And it's really important in your first one to have an understanding of maybe like shadowing this person, getting an understanding of how they do things, the order in which they do things, to get that experience to be able to take on your second project by yourself.
Yeah, integrating yourself as much as possible so that down the road you have that experience when, maybe in your next few projects you want to become the construction manager. As much as it's great to be able to kind of reduce the cost of having someone else come on and take the brunt of the force, like at the end of the day, you want to make sure the project gets done. It's more expensive to get halfway and fail the project than it is to hire someone with experience and come in and actually manage and monitor the project for you. So take your first few projects, bring on someone, partner with someone even who has experience with it. Get yourself on the actual title, get a little bit of equity piece there. Even doing that for your first couple of projects, you're actually going to have the experience that now you can go and say, yeah, I built something. It doesn't matter if you own 5% or 1% of the project. If you were there from step one to the end and take up financing, that's what matters in the lender's opinion. Is you were involved and you were there for the construction. So just get yourself in one way or another, whether it's bringing someone on or you're joining another project.
And I'd say that's probably the most overlooked thing out of all the applications we see with people who are looking to get in from that retail, acquisition of just duplexes, triplexes into this space. It's the one piece that people try to always jump over. It's like, no, I can do this by myself. I don't want to hire a GC because a GC is going to charge me 30% more. It's almost like a pay-to-play situation where, unfortunately, unless that person's your partner, you're going to have to pay to play for the first one to be able to get it off the ground, or at least show a lender that you have the ability to be able to do this. Now, let's say, for example, you want to try to do this by yourself and you have some level of experience and you can try to put a package together that says, look, I've done this before, I know what I'm doing, or I kind of know what I'm doing. You might be able to go to a mortgage investment corporation or a MIC to plead your case. They do, I'm not saying that they're just going to let you build something if you've never built it before, but they have a little bit more leniency when it comes to being able to do your first deal. They kind of specialize in helping you do your first deal, so that might be a better alternative for your first one if you are looking to take this on by yourself.
Yeah, and that's, like Josh said, one of the reasons why we would take a look at that type of lender. When we're taking a look at what types of lenders are going to be available to you, obviously you have your banks. Your big 5 banks probably aren't going to be interested in your project unless you have a fantastic personal relationship with them on some sort of level. A bank guy is probably going to be a credit union. That's who's going to be looking at your construction project from a bank perspective. The other types of lenders are going to be obviously your private lenders, like Josh said, your semi-private, your private guys. They're going to be a lot more flexible on your experience, but they're also going to be a bit more flexible on how much of a leverage you can get. Your credit union financing, your bank financing, you're going to be topped out at 75% cost. Obviously, the hot topic these days is leverage, and obviously just trying to get in with as little as possible. Understanding that's not always going to make your project easy. It may not always be the best option as well too, depending on just the numbers and the surrounding details of that. But if you are looking for leverage, your private guys are going to be where it's at. You're probably going to be limited in today's age at 80% of cost. You used to be able to get 85%, maybe for a phenomenal deal, or if you have some collateral, you can maybe stretch it there. But we're just seeing the lenders really just bringing down that risk right now with the appetite given the economy, and they just don't want to be as leveraged on these projects, especially if it's your first one.
And I think it's important to understand, you can be leveraged at the end of your project if that's something you really want to do and your takeout financing allows it. Absolutely. If you run those numbers and you feel comfortable with that type of financing, CMHC or whatever after the fact, say go for it. But if you're looking to get in development, there's no such thing as minimal equity when you're looking to build something. It is the most capital intensive investment in real estate you could possibly have. The liquidity and capital required to be able to get something like this off the ground is significant. For example, 4+1, you can't do a 4+1 in Toronto without $1 million in cash. The reality of it is you can't put 5% down. It doesn't exist. Your cash into a project on a size of millions of dollars it's not viable without having a large equity position or capital down. And one of the really important things right now in today's economic climate is the lenders are looking for almost the second question on top of tell me about the project is how much cash do you have available? How much equity do you have available to be able to do this? How strong of a borrower are you? It's literally the second thing that comes out of the mouth of every single lender. So if you're looking to get into this, the second thing they're going to be looking for on top of your experience is just access to liquidity, how much cash you have, and your ability to be able to move the project along without necessarily needing the maximum amount of leverage to get your project off the ground.
Yeah, I'd say in terms of additional equity on top of that base amount, especially if you're trying to go directly to CMHC again, which may not be the main focus of these borrowers. But I'd say most lenders we talk to probably want to see an additional like 10% of your hard costs in just like liquid funds to have as reserves. So just kind of obviously keep that in mind. Moving forward into some like the reports and stuff that you're going to have in terms of, again, bringing on partners and professionals, a QS report, a quantitative surveyor, versus some of the lenders that may allow you just to work off of progress reports. Obviously, there's a cost differential here. You're a QS. It varies depending on the size of the firm and their experience. You could be $8,000, you could be $20,000, $30,000, $40,000 depending again on the size of the project. For these mid-level ones, we're gonna be more in that like $8,000 to $10,000 on your top range. Obviously, it's something that you're gonna think about. It's a cost up front. Should you do it? Should you not do it? I wanna find a lender that's not gonna require one. In our opinion as professionals, if it's your first time doing a project, you're probably better off going with the QS. Their whole job is to scrutinize line by line of your budget and your project to make sure it makes sense financially. Are you running with the right numbers, and are you bringing the right amount of equity, and are you in the ballpark to actually be able to get your project done and not show up at 65% completion mark and all of a sudden you're looking for another $1 million because you've completely underestimated your project costs. They're going to be able to take a look at what's going on in the economy as well too. In today's market, what's going on with the cost of the trades and materials, and do you need to bump up your contingency from 5 to 8 to 10%? They're going to be able to help that analysis of your project. And again, nothing is more expensive than like failing on the project and getting halfway through and not having the money, right? So that cost of 8 to 10 grand, whatever it is, versus going bankrupt on a project. Again, for your first few, maybe take a look at that option. And the bank, the lender is probably going to require in most cases as well too. But even if they don't, just consider having that there to make sure your project is going to be on pace for completion.
Yeah, I think every single person who's looking to really get into this should start to normalize like that as a soft cost on their project. The same thing as an architect, like you should just factor it into your costs. As Aaron said, there's nothing worse than having a budget overrun on a project. They're going to allow you to be able to make sure that you can consistently execute on your business plan, and that allows the lender to have faith in your ability to be able to execute as well. There are a handful of different tiers of these types of cost consultants, and as Aaron said, they range significantly based off a project, but we think it's a great way to be able to keep your project on cost. And as a whole, I can't even think of like very many developers when you start to get lenders who you get over a few $1 million who doesn't require one anymore. Previously, maybe a year and a half ago, it wasn't as required, but I think as capital has tightened up and liquidity is required more and more, I think lenders are defaulting to having a third-party professional manage the overall progress of a project.
Yeah, it's going to make it a bit easier as well too, like getting your tranches. Like when you take a look at a progress draw, you're really just taking a look at picturized progress of your building. It's hard to quantify some of the soft costs that go into that when you're just trying to take a look at overall progression of the building. Whereas if you have your QS, when you're submitting your invoices in, the QS is going to be able to go through each line item and just verify, yep, this has been spent and this is allocated here, and just send that over to the lender and the lawyer, and be able to get that advance to a lot easier. So there's definitely some benefits going with the QS for sure.
Yeah, absolutely. Jumping into the next thing, which is equity. Capital equity. These projects, when you're transitioning into your first construction project, specifically, let's say 5 units, you're trying to get into that larger development space. You might not have all the cash or all the equity by yourself. So raising capital is something that most small to mid-sized investors do, whether it's you're partnering with somebody who has the equity or you're raising capital in some sort of structure. It's important to not be like a cowboy here. Like, we really need to understand your corporate structure, whether it's a partnership, whether you have shareholders on a corporation, or you have a GPLP structure. Coming to us and just giving us a bank account statement that has your buddy Joe and your cousin Fred and all the types of money just coming in, that's not going to fly when you're looking to get to this level of development. You really need to have corporate structure figured out and your agreements in place before looking to submit the file. A lender's going to want to see that you have this structure submitted at least a minimum, like a certain level on the submission, to understand how you're pooling your equity and how you're going to fund your project.
Yeah, and if you are bringing partners on, it's a very important conversation to have in terms of what is the exit strategy for them? Are they here for the long run? Are they true partners, not just equity partners? They're here to own and hold the building for you for 100 years, or are they really just coming on as investing partners and bringing them on to the corporate shareholder structure is your way of legitimizing it? If you're going that route and you're really just raising the capital, it's important to understand that the construction files aren't like repositioning an apartment building where you buy it at $2 million and then you refinance it at $4 million and you get all this equity back and you can pay them all out. When you're going with construction lenders, you're just basing your construction loan off the actual cost. So, if you're building something for, $2 million and you get your $1.9 million construction loan, even though your building is going to be worth $4 or $5 million down the road, there is no refinance after until you get into, the building being deemed as stabilized. So once the project is finished, that's it. There isn't that advancement of capital back out to really be able to pay these partners out. So you have to make sure they understand what that repayment process is going to look like. Now, sometimes you can repatriate some of your capital through construction management costs in there. Again, obviously your lender is going to make sure they're okay with how much you're looking to actually add into the budget. But depending on how much you raise, you may not be able to get it all back just by claiming some construction management. So these guys, these investing partners, they may have to ride in through the project for at least 12 to 18 months until the project is considered stabilized. Maybe then you can take a look at adding some sort of pari passu or secondary mortgage to be able to buy them out. With new construction in Ontario, you're probably limited by your debt service anyways, so you're probably not going to be able to add something on in second. So you may have to wait until year 5 to be able to do a full refinance, and hopefully the rental income is raised enough to be able to actually get the value in the refinance then.
Yeah, I think it's safe to say there's a handful of things you need to understand when you're looking to submit your first construction file. Where we usually start is understanding your pro forma, going all the way back to the very start. Having a really detailed pro forma highlighting the risk associated with where your project is going to be at the end of your project. We see so many pro formas where you have the maximum rent, the lowest vacancy, the lowest cost to complete, and that's really not what you want. You want to stress test your deal. You don't want to make it work because you want the deal to work. You want it to have it work because it does work. In a time right now where we're seeing hundreds of % increase in vacancy in some areas, go from 1 to like 3 to 4% in some areas, Kitchener-Waterloo, downtown Toronto. It's important to understand that you're going to be, putting in your pro forma at a higher vacancy rate than what we have now. Highly recommend using specific tools. CMHC has a vacancy tool. You can take a look at specific areas and find historical vacancy. Take a look and really dial in your numbers. Same with rent. Understanding what's going to happen over the next few years. The government has already stated that non-permanent residents are basically falling off a cliff when it comes to bringing these type of people in the country. And what that means is we're not going to have the same amount of people trying to rent the rental stock that we had previously. We're not going to see the increase in rents that we have previously. So, underwriting last year's rent today isn't going to help us. Understanding that we're having a softening in your rents is important when projecting out your takeout financing. And when it comes to overall expenses, I think it's safe to use CMHC benchmark expenses. They're pretty pretty aggressive, that they're definitely more than what you would normally have when underwriting just regular management maintenance. It allows you to be able to leave a buffer with your takeout financing, and just understanding that your takeout financing as a whole with CMHC is going to require those expenses anyways. So when you're looking at creating these numbers, work with a professional who understands your takeout and is going to be able to structure this pro forma in a way in which is going to make sense and profitable in the long run for you. Yeah, guys, obviously there was quite a bit in that video. Might even be easier in a specific conversation about your project. So if you have one, obviously feel free to give us a call. But the idea about this is really just to get you thinking and make sure that you're not trying to skimp out on costs for anything. And construction really is not the type of project to be shaving off as much as possible. So thanks for watching to the end. Definitely hit the like and the subscribe button to make sure that you give us motivation to keep on making more of these videos for you, and we'll see you in the next one.